we are focusing on trends at the Nairobi Securities Exchange. You have seen a number of companies have been releasing their half-year results. Share prices have been falling, and that's why our discussion is centered around the bear run, which essentially means falling stock prices at the Nairobi Securities Exchange. And with me, I have two gentlemen. I have Shachi Logutu from Genghis Capital, where he's a senior research analyst. And I have, yes, I have, from Clan Capital, I have Rufus Nancy. Sorry for that. I actually, it just escaped my mind. Sorry for that. But gentlemen, let's start with the numbers from Kenya Airways, because that was a huge story yesterday. If you look at the numbers, 8.6 billion shillings in loss, and clearly the company's costs are still skyrocketing. It looked to me as though the market had already been pricing in these results, because early this week we had the share price fall to a low we have never seen since it listed at 2.53 shillings a share. If I could start with you, Chachil, what did you make of KQ's numbers?
Thank you, Julian. Starting from the more positive is that the revenues, of course, there was an increase in revenues around 6 billion, but as expected, the costs are still quite elevated. We saw that in 11 billion increase in costs, which is one of the main headwinds in this company. So I think it's still not yet out of the woods yet, the company, so it's something that was quite expected by the market. Yes, on one hand, there's some efforts that have been tried to be made by the management, but clearly it's not translating to the bottom line in the company's results.
Okay.
Yeah.
And Rufus?
Yeah, so it looks like the numbers were welcome. Judging by the performance even yesterday, there was quite a jump. I mean, it was one of the top gainers yesterday. But looking at the numbers specifically, yes, the up in revenue was okay. But I think the main sticking point is the revenue, which we think might be the same story continuing for a couple of quarters, because as we know right now, they're still in the middle of a long-term re-strategizing. So with that in mind, I think the performance will likely stay the same in terms of share performance and in terms of the financials. So from an investor standpoint, we may see a bit of jump here and there, but I think the price will still remain depressed for some time.
Okay.
Yeah.
And speaking about restrategizing, the plan for renationalization, Michael Joseph made it very clear that it is not what we want to do, but it's what we need to do to be sustainable. Right. What do you make of that, Chachil?
Well, it's not the best of the way out to this situation. So, I mean, I support what he's saying, sentiments, but nonetheless, that renationalization is not a freelance. I mean, it will now come to the taxpayers' pocket, which will now be able to foot that bill in when it comes to be nationalized. But of course, the recommendations behind it, or the thoughts behind it, is something to make it more sustainable, or to emulate what the other fellow competitors are doing. You find that Ethiopian Airlines, or even the airlines from the Middle East, they are more or less quite subsidized by the national government. So it's something that we are trying to be at par with where the competitors are, at least in a way to reduce the cost. So I think it's not the best way out, but right now it's the only way out.
But Rufus, to counter what Chachil here is saying, not that I remember, but from my reading, when KQ was privatized in '96, the argument was we need to stem this loss-making tide. Right. So now it looks like we are going back to where we were in around '95. And my concern is that I don't think Kenya has ample fiscal space, or deep pockets, if I could say, to be able to continue giving subsidies, especially to an entity like Kenya Airways. I don't know what you would say to that.
Yeah, I mean, I'll agree with the sentiments. It's not the best viable solution here, but who are the takers there? I mean, there's not been any takers to to come and plug in that hole. So the only position they're left with is to approach the government to at least carry the basket until someone shows interest. So as it is right now, I think the words by the chairman were right. Short term, I think that's the only sustainable solution. Okay, but long term, I think there's going to be some. But again, looking at just wider industry, that is the norm. Most of the airline businesses are actually backed by, or partially backed by the governments. So, and that in itself has actually contributed to some of the performance we've seen in some of the biggest airlines within Africa. So I guess, look, nationalization, no one wants to talk about it because there are also the attachments to do with political interference and things like that. But I think if you're able to manage this whole process very well to kind of usher us into a full market position, then that would be ideal. But again, I don't, from an investor point of view, from the market point of view, I think the market is still digesting this whole nationalization narrative. Okay. As just judging by how the things are looking, I think people are not really convinced. They think for similar businesses that are backed by government, there's not so much of a good story to look at. So there's that issue as well.
Okay. And staying with the results which have just been released and the market, I think, just is about to open. The Nairobi Securities Exchange itself has just released results this morning, and if you look at the numbers, they're not too good. Revenue is down 18% to around 290 million shillings. Total income is down 15% to about 364 million shillings, and profit after tax is down 89% to 13.5 million shillings. When we look at the Nairobi Securities Exchange as a listed entity by itself, I always like to look at it as a toll station because all the transactions eventually have to happen there. Mm-hmm. Why are we seeing such adverse numbers from the exchange, Churchill?
Well, it's expected. If you look at the market trend in the last 6 months, you've seen that there's been a decrease in volume traded in the market. So it translates even to the revenues that NSE as a listed company gets at the end of the day. So that's widely expected. You've seen the numbers, the volumes coming down, and of course it has also been represented with the bear run in the market, so it's expected.
Okay.
Yeah.
Rufus, I saw the share price was now oscillating around 11 shillings. It started the year at about 14, 15 shillings. Right. Where do you see this going as far as the NSE is concerned?
Well, the company itself, it's going to take a hit. A bigger chunk of their revenues come from transactional, revenue. From the business itself. And as I said, we've seen a big drop in turnovers for both equities and bonds, and so that itself, it was expected that yes, NSE as a company was going to take a hit in their revenues. But just to expand that whole question, I think they're also into some other misguided programs like derivatives and things like that. I don't think that does not augur well with the business itself. And then tied into that is we've not seen really an emphasis on more digital trading and things like that. As it is, most of I'll say maybe just half, but we need to see a big push towards that direction. We've seen other stock exchanges, right across from Middle East, for example, the Istanbul and some in North Africa, really putting an emphasis on digital trading. We're not seeing it here. So most likely it's going to be the same story. If you look at NSE, most of the revenues really, they're kind of flattish in a way, going back, say, 3 years, for example. So it's not a stock that really takes a lot of interest.
Okay.
Yeah.
And just to stay with your comment on derivatives, before we go to our main conversation, you did mention misguided strategy. Some of the skeptics of the derivatives market always say that the focus should have been on deepening the liquidity in the market as opposed to launching more complex products. Right. It sounds like this is a view you share.
Correct. Look, we do very poorly. Our turnover rate is about 10%. Basis, okay, and we've been there. Actually, the correct number is about 8. Compared to something like, say, JSE, Johannesburg, it's about 30%, okay? The main thrust there should be, should we broaden the space, have more numbers listing, right? And encouraging people to trade. Let's build the core market first before we introduce this other derivatives market. The whole notion behind the derivatives was, let's have, since we have a bigger percentage of our businesses, of the listed stocks traded by foreigners, okay, let's give them an option. The idea was to open up the rest of the market. But when you look at the products that they've already released, right, that they want people to trade in, the same numbers, same names that are already, very market. Active, yeah. So I don't know what was the aim there. So everything just cancels itself out. So that's why I say it's misguided. And I'm sorry to say, I don't think this project is going anywhere.
Okay.
Yeah.
Churchill, I think you need to share your views on the derivatives, especially around product diversification at the Nairobi Securities Exchange.
Yes, I more or less share the same views as Rufus. We look at derivatives and who are the main takers of derivatives. Ideally, looking around, it's just high net worth clients and institutional investors. Mainly, those are the target market. We are not even talking about the retail market. But I find that right now, most of them are quite risk averse to go into equities. So whatever product it is, be it derivatives, bottom line, their underlying is an equity instrument, so that's something which is quite risk averse to them. So I'm not seeing them taking off into this derivatives market, but derivatives product, so to speak. But in terms of diversification of products in the market, I think it's still at an early age for us. As Rufus had just mentioned, we need actually to sort of develop the current market to see boost liquidity, to speak, because if you look at the equity space, we have like 58 stocks in the NSE, but what is the investable stocks that it close to, at the best, is 10 stocks which are quite investable. So we find that 48 of 58 stocks are not investable, so to speak. So it's something that NSE has now to do, or the regulators, they have to come up and try to boost the market as a whole.
Chachila, you mentioned that when you talk about equities, you're essentially talking about stocks. When you talk about liquidity, you're talking about the kind of volumes we see being traded on a day-to-day basis. Yes. And that being risk-averse means that your tolerance for risk is extremely low. You don't want to take high risk. It's just good to ensure that we are on the same page with all our viewers. And now let's get to our subject of discussion today, where we're discussing the trend we have seen at the stock securities exchange, where the prices have been generally falling. Especially starting late last year. And this is essentially what is typically referred to as a bear run. We now see the NSE 20 share index, which is an index which tracks the market's performance, at lows we last saw in 2009. I remember the day it fell below the 2,600 mark. We actually reported it. Then shortly later, it was below 2,500. When you look at this trend, what do you make of the market as a whole, Rufus?
Well, my exact sentiments are, good times are back. I mean, we've never seen these lows. The last time we saw, same trading levels was, I think, 2017. So there's a lot happening. I mean, sentiment is a bit depressed. And a whole host of other things externally as well, global tensions, stuff like that. But speaking specifically for the market, I think, this has been the trend since 2015. We've just been seeing general weakness, okay? The sentiment is not as strong. Right now is when we're seeing foreigners, being net buyers, but they have been net sellers for, going back since 2016. So there's that, it's not really a clear picture. But now, speaking on the performance itself, largely, I'll say the market has been flat, okay? And that's usually the trend, especially post-earnings season, just right after March. There's always just a debate on where is the market going to go. And right from April, we're just seeing a very flat market, okay? And that in itself says, we do not know, we're not sure where the market is going to go between buyers and sellers, okay? And I think just now, about a month or month and a half, I think the sellers won, because now we kind of now dipped about we lost about 100 points. Okay. But generally, I say it's good times because we're still around the same area where we see a lot of buying interest coming back. And I'll say this, just looking at the market technically, the same levels in 98, same levels in, I think, 2004, same levels in 2017, and I think a period in between there. The 2,500 to 2,700 is always where we see buying interest coming back. So when I say good times are here, I think if history serves us right and if possibly we see a repeat, then we're likely to see the market sort of finding some balance here, and perhaps seeing a take up in pricing.
Okay.